Okay, we've had a slight change in schedule. We'll have Pasofino Gold Gold Limited up next. So I would like everybody to please welcome Brett Richards. He's the Chief Executive Officer of Pasofino Gold. Pasofino is focused on advancing its Dugbe Gold Project in Liberia, one of West Africa's most promising gold development projects in partnership with the Liberian government. Please welcome Brett to the stage. Thanks.
Michael, thanks very much, and thank you everyone for hanging around. I know I'm probably one of the last presentations, but I love your stamina. I'm going to talk a little bit about Pasofino Gold and our project in Liberia. As Michael alluded to, we are listed on the TSX Venture Exchange under the ticker symbol VANE. We have a market cap today of about $60 million, and Pasofino has one asset. We own 100% of the Dugbe Gold Project in Liberia, and we've had it alongside of our former parent company, Hummingbird Resources. We've had it since 2009. We own 100% of the project, but the government owns 10% free carry interest. The project has 3.9 million ounces of gold, and we have a fully definitive feasibility study done on the project that I'll talk about a bit more in a minute, but it was done in 2022, and our efforts going forward are about updating that feasibility study, given, if nothing else, the significant difference in the gold price environment over the past 12-24 months. We also have one of the largest land packages of any mining company in West Africa. We have over 2,000 square kilometers under license, of which we currently use about 8% of it for our footprint of the project. We just raised $5 million last week. We closed a non-brokered private placement, and the use of proceeds is really designed about to update the feasibility study. Nothing more. We're not drilling. We are simply going to update the feasibility study and get this through its next stages of development, which are going to be project financing and ultimately to a construction decision. We've got 127 million shares out, and management and insiders own almost 68% of this company. We have about a 32% free float. That's why we have very low liquidity, but we, management and our major shareholders who are on the board, control 60% of this company. We have a board consisting of 3 of our major shareholders and 3 of our former board members. And also we have an agreement with our shareholder I'll speak about in a minute. But really, as an investor, you know, it's really about why are we here? And you guys are here because you want gold exposure. You want to hedge against inflation. You want a risk-adjusted return, blue sky. You want everything. And in this gold price environment, I think this is a project that can give it to you. And I think Pasofino can make people money. Look at where we are headed with regards to the gold price environment. You know, certainly the banks calling $3,000, $4,000, $5,000, $6,000 gold. I don't believe it as strongly as maybe the banks do, but we are in a very, very strong environment for gold price run, and quite frankly, $3,000 was kind of out of our belief a year ago, and here we are sitting at $3,350 today. When I look at our resource and the stage of development we're at, you know, typically 10, 15 years ago, we would get $180 an ounce for reserves. We would get $80 for M&I. We would get $20 or $30 for inferred. And if we did the calculation based on our mineral resource inventory of, you know, 2.7 million ounces of reserves and the remaining and indicated and inferred, you know, we would have a valuation of $558 million. So starting at a starting point of $60 million today, you can appreciate that there is significant upside to where we could be trading prior to production and going into production. As I mentioned, our major shareholder was Hummingbird Resources. Now it is a bank and a private equity arm of a bank called Nyoko Resources. And we signed a 2-year kind of cooperation support agreement with them a couple of months ago, whereby they are obligated to fund the 50% of their interest in the project for the next 2 years. They are obligated to bring 50% of the project financing to the table. They are obligated to, we have a standstill agreement where they cannot make a bid for the company for 2 years, and neither can I sell it for 2 years. So we have a governance model that is very, very balanced. And what it has done, it has almost forced all parties to behave in the right way for the project, and that will be in the right way for all shareholders, and that is to advance this as quickly as possible and get this into production as quickly as possible. Back in 2022, the project economic outputs from the feasibility study were quite compelling back then. $435 million capex and a $564 million post-tax NPV at 1,700 and 761 at 2,100. And we can sensitize that up, and I'll show you what that looks like today, because ultimately we're not really changing the size, scale, or scope of the feasibility study. We're simply updating the costing, and we're updating kind of the gold price environment we work in. So this optimization study is really about updating the economics to a bankable level. This is our mineral resource inventory at our 2 pits, Dugbe F and Tucson, where we have in aggregate around 3.9 million ounces. So we have the study completed. We have all of our permitting ready to be submitted for approval, and we will do that in the 3rd or 4th quarter of this year in alignment with updating our tech report and our feasibility study. But this is a large asset. This is a large land package, and the potential here to have a generational size mine is quite obvious. So, you know, one of the things I look for as an investor, I look for size and scale, and yes, I look for grade and metallurgy, and I look for access to infrastructure. And the Dugbe project ticks a lot of those boxes. We have to build a lot of our own infrastructure, but it's very, very doable. I think the most, I'll say, under-talked about story in Africa generally, and West Africa specifically, is about Liberia as a investment case. Liberia is one of the most stable countries in Africa, and one of the reasons is because of its connection to the US. It has a very large US embassy. It has a lot of US diplomats and expats there. It trades in US dollars, and it speaks English. On top of that, they have not complicated their, I'll say, framework of taxation or their framework of ownership. There are only 6 operating mines in Liberia. 4 of them are iron ore, 2 of them are gold, and they're all very, very large operations. But they allow for companies like us to enter into a mineral development agreement, which is much like a mining convention, which lays out your framework for the next 25 years. And we have a mineral development agreement in place since 2019. So this is, I can't speak enough about Liberia. This is one of the most favorable jurisdictions I've ever worked in. I built 4 mines in Africa, greenfield. I've built 2 brownfield, and I've worked in places like the DRC twice, Mali, Burkina, Sierra Leone, and Guinea. And by far, Liberia is one of the most attractive jurisdictions geopolitically, and the support we get from our joint stakeholders. The project is about 76 kilometers away from a major port, and that port is called Port of Greenville, and it's about an hour flight or a 6-hour drive from Monrovia, which is the capital. So we will bring all our gear in by water into the Port of Greenville and then truck it down a 76-kilometer road to our site. But you can see the size of our land package completely contained within Birimium geology, and the expansion ability for us to, and I'm not here to grow a big gold mining business. I want to get this into production. I want to make this as profitable as possible. and I want to keep it in production for as long as possible. We'll make strategic decisions what we do with our free cash flow down the road once we are de-risked. But there is quite a bit of infrastructure that needs to be built here, $40 million of collective infrastructure, about 10% of the capital. And some of the trade-off studies we're going to be doing during this update to the feasibility study, we will be looking at things like outsourcing our power to bring our CapEx down, recognizing it's going to bring our all-in sustaining costs up a bit, but we will be looking to de-risk this project from a construction standpoint as much as possible. We will also be looking at contract mining, and we'll be looking at contract administrative services wherever we can. Just the all-in sustaining cost of this project from the previous feasibility study are at $1,005, $1,005. I would sensitize that up to today's environment, probably going to be closer to $1,200 or $1,300, which feels about right. And our CapEx maintaining that $400 million number. So I feel that we're kind of going to be in a space where we're not going to have material changes to the economic inputs and some of the economic outputs, with the exception of revenue and net present value and IRR. Just an overview of the mining strategy, fairly simple stuff. And this was all kind of developed from the previous feasibility study. Process flow sheet's quite simple. It's 5 million ton a year. Right now, it is whole ore leach. It is crush grind, ultrafine grind, and CIL. And it's fairly simple, although the recoveries from that process are about 83%. And we're going to investigate whether possibility of introducing flotation in year 3, once we are debt-free, we can finance flotation, possibly bring this up to closer to 90%. But we need to do some mass pull studies and some met test work. This is probably the most interesting slide, what I like on the chart. You can see the second column is really the economic outputs at $1,700 gold, where we ran the last feasibility study. And you can see the post-tax NPV at 524. It's 5 million tons. This project will do 171,000 ounces a year for 14 years. However, it'll do 200,000 ounces a year for the first 5 years. It's got a 4-to-1 strip ratio, 1.3 grams, and as I mentioned earlier, 83% recovery. But you can really see how this starts to gear up when we start to talk about using different gold price assumptions. Really doesn't affect many things but revenue, because we are not going to take the view that we want to change the resource model. We don't want to change the mineral resource inventory that we have right now. We don't really want to materially change the mine plan, because the scope of what we feel we can build is being driven by CapEx. And if we start to look at all of these nuances to build the ultimate project, the most optimized project, we would be looking at $700 or $800 million. And we want to keep a project where we can control and build ourselves. But this really does gear up at $2,700 gold. We have a post-tax NPV that's 4 times CapEx. And at $3,300 gold, you can imagine it's 5 and 6 times post-tax NPV, and the IRR is close to 70 or 80%. We'll update all these numbers when we get through our feasibility study update. That is going to take us about 7 or 8 months. I fully expect that we'll have an updated tech report and an updated feasibility study by early Q1 of next year, file our NI 43-101, and in parallel, we will have been working on project financing. Keep in mind, I have a bank as a major shareholder who have committed to participate in the project financing, so it makes my job a little bit easier for the next, certainly when I go to raise project financing. Just some of the activities we're going to do. And one of the optimization studies we're going to look at is flatlining the production profile, and that will come with some resource development drilling we will need to do in the, from day one. But over the next 12, 18, 24 months, and 36 months, you can see a path where we have 8 to 10 months of updating the feasibility study, 24 months of construction. This is probably one of the projects in this room, in this conference, that's closest to production But the valuation differential between being valued on inventory of ounces in the ground today, we are valued at $15 an ounce, to transitioning in the next 36 months to being a multiple of free cash flow, those two valuation differences are quite tremendous. If we do $300 or $400 million of free cash flow a year in full-scale commercial production, as per the feasibility study, that's $1 billion company. And we're a $60 million company today. So scope to increase value, create value for investors. This is the project that you won't find very many like this. So anyway, thank you for hanging around. Thank you for your time. And Michael, thank you for the thing.